Hi guys, in this video I'm continuing the saga of personal finances with some general remarks and let's call them recommendations that will help you protect and increase your hard-earned money. So first things first, before jumping into the topic of this video, I wanted to say that in the coming month, towards the end of the year, my videos will be a bit rough, a bit less fine-tuned, more run and gun style.
You want to run and gun, man? Stay in patrol.
I will be traveling this period and I, first of all, don't have much time to plan and edit my videos. Second, I don't really have a studio or at least a dedicated room to film. So I will be shooting whenever I can, wherever I can, be it on a balcony, in a park or in a seminar classroom. Alright, so with all this aside, what should you consider when investing? And when shall you start investing? Is it too late now? Is there a bubble? Will it burst soon?
There's a bubble.
How do you know?
Trust me, call Venet, buy 50 millions in swaps.
Just to understand where I'm coming from, my style of investing is long-term, value investing, Benjamin Graham style. So if you share the same approach and view things on the long run, then you should not be too worried about market fluctuations. Bubbles come and go, but investments in sound businesses, in valuable assets, will be safeguarded on the long run. However, finding those sound businesses and valuable assets is easier said than done. And there is one thing to worry about, and that is the return of investment, not the return on investment. This comes later in focus. So the most important thing in investing is the return of investment. You want to get the money that you invested back.
Show me the money!
Nothing is guaranteed to offer that 100% certainty. And frankly speaking, if you see a video promising great returns, then that's a big warning sign. The way I go about it when dealing with uncertainty in investing is by investing in things I understand and building up knowledge first before I invest in something new. Similarly to what you do now, hopefully, by watching this video until the very end. By the way, if you want to support this channel, please give a thumbs up to this video and, if you will, please share in the comment section below one of the most successful, or why not the least successful investment you've had. And if you haven't yet started investing, just comment one of your planned future investments. Coming back to the return of investment example, I personally try to avoid high return assets that seem too good to be true. In general, high return comes with an even higher risk and makes them unappealing. If one were to calculate the return of such an investment, adjusted with the likelihood of the cash flow, it would most likely be negative. Take the casino business, for example. It is very obvious that playing in a casino is not a good investment. Actually, one could hardly name it an investment at all. The returns advertised for playing in a casino are really attractive, but are they really worth it? If you were to calculate the expected return of, let's say, playing the roulette, you would realize that it's actually negative. So in the roulette game, the wheel has numbers from 1 to 36, divided equally between two colors, red and black. If this would be it, then the expected return is 0. On the long run, a player would not lose or make money. However, there is another detail on the wheel. One additional pocket colored in green and numbered 0. This is the advantage of the casino over the player, and it accounts to 2.7% of your losses. Every 37 spins, you can expect to lose $0.027 for each dollar played. And if this is not bad enough, there is another version of roulette where there is an additional green pocket numbered 00, increasing the house edge to 5.26%. Anyways, playing this roulette game will give you an expected return of minus $0.05. You can see the calculation down below. It's basically each outcome weighted with its corresponding probability. 1 in 38 are the odds of winning. Only one pocket will be the winning scenario for a straight up bet where you basically bet on a specific number. And 36 out of 38 pockets will be the losing scenario. This whole roulette story was just to emphasize that investing in whatever asset class or business where there are more chances of losing money than winning, giving a negative expected return, is not advisable. I personally have 1% to 5% of my entire portfolio invested in such risky assets. And here I would include crypto, angel investing, and even IPOs. I'm of the opinion that for somebody just starting out investing, funds and particularly ETFs are the best choice. I'm talking about investing 100% of your saved money and being okay with this. Not panicking or checking the news and portfolio every single hour.
Don't panic! Don't panic!
Why ETFs and not mutual funds? Well, there are plenty of videos on YouTube explaining the differences between ETFs and mutual funds. But just to give you my reasons why I prefer ETFs over mutual funds, 1, they offer increased liquidity, and 2, they have lower costs and offer great value. And I don't know about you, but I love good value for money.
Value for money is all we're after.
The liquidity part is quite straightforward. One can buy and sell the funds unit in whatever trading day they want. And on the value/cost point, simply check out this graph. In mutual funds, stocks are picked by investment managers after careful considerations. There is no significant evidence that mutual funds consistently and significantly outperform ETFs. And trust me, I researched that. So why pay a premium for somebody to pick stocks in the fund if this is not justified by the return? Okay, just to wrap this up, here are some of my picks for ETF investments. I'm really bullish on technology, not necessarily on the big internet giants, but technology in general. So here are some of my darlings, and they are not ranked in any particular order. One of them is Vanguard Information Technology, a pure technology ETF. Another one is Nasdaq Top 100 Companies, predominantly tech. There are around 50% tech companies, but still like a great ETF, and it has a very low cost ratio. ARK Innovation ETF, this is my favorite of all, except one little black sheep that prevents it to be almost perfect. And that black sheep is Tesla. I think there is too big of a hype around Tesla, and I don't like the stock, at least not anymore. Don't get me wrong, I love their products, just not the stock. If the fund would exclude Tesla, it will be just perfect. Another option, a bit more specific, is PSI Semiconductors, a fund made out of stocks in the semiconductor business. Okay guys, this was it. See you in the next one. Bye!